John, Wall Street has a pretty good consensus on an atrocious second quarter, but a strong rebound in the third quarter. Is that your base case?
Well, definitely we're seeing, horrible data for the second quarter as we're always seeing that data, obviously in retail sales and in employment and other indicators. So that I agree with. In terms of a bounce back, I do think that as we see when restrictions are relaxed gradually over time, based on what's happening with the coronavirus, we will see a return to certain sectors of the economy. In particular, I see construction, which has been hit really hard and is very important, obviously, for our economy here in New York. I expect that to be able to bounce back a bit more quickly than maybe some of the other sectors. But I don't see the economy being back to full strength by the end of the year, or it's going to take longer to get us back to where we want to be.
John, let's talk about some of the programs you have in place. The immediate concerns of the Federal Reserve were the Treasury market and the mortgage market and some of the overnight credit markets. Do you feel like those have calmed down? Do you feel like you have a handle on them to the extent where they're functioning more normally now?
Well, you're right. That is where we started, because when the pandemic really started to spread and market participants were getting more concerned about the economic impact and the uncertainty about that, we saw that enormous tidal wave of money moving from riskier assets and from around the globe into shorter-term safe assets. And the financial system, in a way, was overwhelmed by that flow of money. And that's why we saw the illiquidity and some market functioning issues. And what's really the cornerstone of the global financial system, that's the U.S. Treasury securities market. And that's where we intervene most quickly and at an enormous scale in terms of our buying of U.S. Treasury securities, mortgage-backed securities, and agency commercial mortgage-backed securities. That was our initial where we saw signs of concern, and we acted promptly and decisively, and we have seen significant improvement in liquidity and market functioning in those critical sectors. And, in my view, is if you don't get those healthy, then it's impossible to make sure that credit is flowing more generally. So that's where we were focused initially. I think those efforts have been successful. We're still purchasing, but as you've seen, we've cut back on the purchases because we've seen improvement in those markets. So we're seeing liquidity and functioning improving there. We're also seeing that spill over into these other markets, whether it's a money market, mutual funds, or commercial paper, and even corporate bond market. So now that we've seen, I think, a return to more stable and better functioning core financial markets, that's helping all the markets, I think, function better. Of course, we've got other programs I'm sure you'll ask about that really are to support that and to support credit. Well.